These markets are broadly classified into primary market and secondary market. Primary markets where securities are first time issued. Secondary market where existing securities are traded. Together they offer investors liquidity, transparency and regulatory oversight. We'll discuss on financial instruments. Securities are tradable instruments with monetary value. These include equity, debentures, units of mutual funds, government securities and derivatives. Equity securities, equities, equity shares represent ownership in the business. Debentures bonds indicate debt owed by issuers to the holders. And units of mutual funds, government securities, and derivatives, each serving different investment purposes. So investors choose securities based on risk, based on return and investment horizon. How the securities market is structured. We'll discuss about the key entities and their roles and responsibilities. The market comprises several interlinked players. Who are the players? Issuers. Issuers are corporates, public sector undertakings, government, and intermediaries. Intermediaries are brokers, depositories, that is NSDL, CDSL, and custodians and registrars. These are all called intermediaries. And investors, retails, institutional investors, FIIs, HNIs, MIIs, stock exchanges, NSE, BSE, clearing corporations, and regulators, SEBI. SEBI ensures fair play, transparency, and investor protection. SEBI is the regulator. Then why securities markets matter to an economy? Because these securities markets play a strategic economy role with the efficient mobilization of the capital and transparent price discovery, enhanced liquidity and tradability, support for entrepreneurship and innovation. So they reflect economic health, support policy effectiveness, and promote inclusive financial growth. Technology is powering modern securities markets. India's securities market has evolved technologically. Mobile, app-based trading, UPI integration in public issues, AI-driven risk monitoring, blockchain pilots in trade settlements, cloud-based back-office systems. So these ensure scalability, faster settlement, fraud detection, and user-friendly access. So exploring financial securities and smart investment frameworks. So the range of securities in financial markets. In Indian markets, securities includes equity shares, preference shares, bonds, debentures, mutual funds, government securities, REITs, InvITs, derivatives. So each serve different needs for investors and issuers. Growth, income, and diversification. Choosing between equity and debt, a perspective for issuers. Issuers select between equity and debt. Equity, no repayment obligation. That is why issuer go for equity, because there is no repayment obligation, but dilutes ownership. Whereas in debt, fixed interest cost will be there, no dilution. but repayment is a mandatory. Decision factors include cost, control, market timing, and risk appetite. Based on that, investor will, based on that, the issuer will go for either equity or debt. Then equity capital, ownership with potential upside. Equity represents ownership in a company. So the features, voting rights will be there, dividend income will be there. It is not mandatory, but if company declares dividend, high return potential, liquidity in secondary markets. So equity is suitable for risk-taking investors aiming for long-term growth. Whereas in debt securities, predictable return with lower risk. Debt instruments include debentures, bonds, government securities, etc. And the key characteristics also fixed rate of interest. Maturity period will be there. Credit rating based only. Lower risk than equity. So ideal for conservative investors seeking regular income. So should you choose equity or debt? Then the question. Factors that influence choice are the risk tolerance, investment tenure, and return expectations, liquidity needs. So often a blend of both is recommended for balanced growth and income, equity and debt. That is called hybrid securities, bridging equity and debt. Hybrid instruments often mixed benefits, convertible debentures, preference shares, REITs and InvITs. So they combine equity like upside with fixed income trades. And there is a commodities. Commodities, tangible asset as investment avenues. Commodities include gold, silver, crude oil, agriculture products. As an asset class, hedge against the inflation. Uncorrelated with equity or debt and volatile but real asset based. Commodities are asset based. Investors access them via futures or commodity mutual funds. And derivatives. Derivatives are instruments for hedging, speculating, and arbitrage. Derivatives derive value from the underlying asset, like futures, options types, futures, options, swaps. So used for risk management, used for leverage, or directional bets in advanced portfolios. Strategic asset allocation and diversification. Core principles are asset allocation, splitting fund across asset classes. Diversification, spreading risk across the instrument, across the sectors. So this reduces overall portfolio risk without compromising expected returns. So what derivatives and what drives investment decisions? So the key factors for investment decisions. Influencing elements include goals and risk profile and inflation expectations, market sentiment, economic indicators. Successful investing blends analysis, discipline, and consistency. Now we talk about equity investing, price, value, and market perception. So stock prices may not reflect actual value. Understand price is equal to what you pay. Value is equal to what it's worth. That is value. Tools like PY ratio, book value, discounted cash flow, these are aid in this assessment. Now, building a successful equity investment process. I'll explain the steps involved. Stock screening, then fundamental analysis or technical analysis, portfolio construction, performance monitoring. So investor discipline is the key in managing volatility. Inside debt investing, key considerations. So for debt investing, credit rating, key considerations. One of the considerations is the credit rating. Coupon rate will be there. Duration also you have to see. And issuer background also we have to see before investing in these debt investments. So suitable for conservative investors preferring a regular and stable income. And building a debt investment strategy, I will explain you the steps. First, identifying the risk return expectations. Then choose between G-Secs, PSU bonds, corporate NCDs, etc. Then match with investment horizon. How much you will get in investment, and monitor macroeconomic indicators. So debt strategy is a complements equity for stability. Now we'll discuss on primary markets. These are building blocks of capital formation. Unpacking the primary market, so the purpose and benefits. Primary market is where new securities are issued for the first time. So it enables capital raising from public or private investors. Offers investment opportunities at initial offer prices. Fuels business growth, infrastructure, and innovation. Now we'll see the difference between primary market and secondary market. Purpose. Primary market, it is a capital raising. Secondary market, trading of existing securities. You see the price discovery. In primary market, it would be a fixed price or book building. Whereas in secondary market, is a market driven. Investor benefits, yes. In primary market is a fresh allotment. Secondary market is a liquidity and exit. Then what are the key intermediaries in the primary markets? They ensure issue success, transparency, and investor protection. They are merchant bankers, underwriters, registrars to issue, legal advisors to issue, and bankers to the issue. They are the intermediaries, the primary market, and understanding issue types in primary markets. In primary market, there is a public issue, rights issue, bonus issue, private placements. Public issue open to all. Rights issue to existing shareholders. Bonus issue, free shares from profits. Private placement, select institutional or strategic investors. Types of issuers and their objectives. Types of issuers are corporates, banks, NBFCs, corporates for expansion, banks for regulatory capital, government for fiscal needs via bonds, startups seeking growth funding. Then classifying investor categories. Retail individual investors, RIAs, QIBs, qualified institutional buyers, HNIs, high net worth individuals, anchor investors. So each plays a unique role in the market depth and pricing. Now we'll see the legal framework governing primary markets. Legal framework. SEBI, ICDR regulations are there. Companies Act 2013. Securities Contract Regulation Act. Listing guidelines from exchanges. These are the legal frameworks. Then types of the public equity issues. IPOs, initial public offering. FPO, follow-on public offer. And OFS, offer for sale. So each method caters to different capital or ownership restructuring needs. How public issue are priced? Fixed price offer, book building, price determined via investor bids. That is book building. Hybrid mechanism, SEBI mandates transparent pricing disclosures. So I will explain you the process of public issue. simple steps. Board and shareholders approval is required. Appointment of intermediaries. Filing of draft prospectus. SEBI comments and then final prospectus. Open and close the issues. Open the issue and close the issue. Allotment and refund will be there. Then next stage, listing on exchange. So the prospectus include the official investor document. So company profile will be there, risk factors, objects of the issue, financial data, promoter details will be there in the form. It forms the backbone of investor decision making. So the application process in public offers. Investor apply using ASBA. ASBA is application supported by block amount and UPI for retail investors. Bidding platforms provided by the exchanges. Then listing, bringing securities to the market. So after successful issue, shares are allotted to investors, listed on exchange for trading. Market prices begin reflecting demand and supply. Now, what is the right issue? Is a tool for existing shareholders, allows current shareholders to maintain their ownership percentage by buying more shares available at discount price, regulated under SEBI and Companies Act. Rules for public issue of debt instruments. It is governed by SEBI NCS regulations, credit rating mandates, trustee appointment, debenture redemption reserves, and step-by-step debt public issue process. Similar to equity, but includes credit rating disclosures, and then trustee due diligence, and interest payout terms, security over information, understanding the private placement. Now I will explain about the private placement, issuance to select investors. So this is a very faster route and less expenditure. Customized terms will be there, limited disclosure requirements, used by generally corporates, startups, and governments. Now we'll go to the secondary markets. This is the engine of liquidity. What secondary market really do? It provides a platform for trading for existing securities and price discovery, very easy. Liquidity for investors, and this is a real-time valuation. So the segments in the secondary markets: equity market, debt market, derivative market, commodity market, SME platforms. These are the segments. Then who are the market players and infrastructure? Investors, brokers and sub-brokers, clearing members, market makers, stock exchanges, clearing corporations. Then who are the brokers and client onboarding? SEBI registered brokers are there. Verify KYC, facilitate trade execution, maintain investor records, and ensure compliance. How trades are executed, the process, execution of trading. So first we start with placing an order via broker platform. We'll place the order, then matching in exchange system, then confirmation and reporting, then trade settled via clearing corporations. Behind the scene, clearing and settlement will be there. This is T+1 or T+0 cycle clearing, calculating obligations, settlement, transfer of securities and funds ensured by NSCCL, ICCL, etc. So the trading life cycle, investors' perspective, investor activities, place the order first, then receive contract notes, then pay funds, pay or receive securities, pay or receive, depends buying or selling. So securities will be credited to demat account. Now we'll see the regulation and market surveillance. SEBI, exchanges, BSE, NSE, and clearing corporations monitor price manipulations and enforce circuit filters. publish compliance reports. How market risk is managed? Risk management tools are there: margins, position limits, circuit breakers, surveillance systems. So this is the way of market risk management. And rights and grievances redressal mechanism. Investors are protected by a SEBI scores platform, and investor grievance redressal panels are there. Arbitration and ombudsman system is there. Now we'll talk about debt market trading, special considerations. Debt market, lower liquidity versus equity, institutional focused and SEBI regulated market, trade reporting platforms. Now we'll talk about mutual funds. Mutual funds, collective investment simplified. So amount will be collected. What exactly is the mutual fund? A pooled investment. This is a pooled investment vehicle managed by the professionals. Diversified portfolio and suitable for retail and institutional investors. This is regulated by SEBI, and the core concepts of mutual funds we'll discuss. The terms is NAV, net asset value, and expense ratio and exit load. AUM is assets under management. Now mutual funds are open-ended mutual funds and closed-ended schemes. Open-ended mutual funds are available for purchase or redemption anytime. Examples: large cap funds, mutual cap funds, ELSS. So available purchase or redemption at any time. Whereas closed-ended schemes, those are fixed ending. Listed on exchange, post NFO, includes FMPs. This is fixed maturity plans, capital protection funds. They are all closed-ended schemes. So active versus passive investment styles. Active funds, fund manager decisions. Passive funds, track indices like Nifty, Sensex. Now we'll talk on investment process in mutual funds. Through SIPs, systemic investment plannings, and lump sum also can be invested. Online, offline platforms, distributors are there, RIA are distributors. We'll talk about systemic transactions. Systemic investment plan, SIPs, STPs, systemic transfer plans, SWPs, systemic withdrawal plans. So these are all systemic transactions. And switches and fund transfers. Switch between schemes within the same AMC based on strategy. How to read mutual fund literatures is available. KIM, Key Information Memorandum, SID, Scheme Information Document, and fact sheets. Now we'll discuss on pros and cons of mutual fund investments. Positives are diversification and the professional management, and liquidity is easy. Whereas cons are costs, market risk is there, exit load. Then we talk about SEBI regulations of mutual funds. Ensures transparency, disclosure, and fair pricing. And service mandates and investor rights. Mandates are timely NAV publication and clear redemption timelines, complaint redressal systems. They're all mandates. And specialized funds, examples like ETFs, fund of funds, international funds, and thematic funds. So the derivatives are financial contracts based on underlying equity, commodity, currency, interest rate. So the fundamental concepts: lot size and the expiry, strike price, and the premium, and market to market. The types of the derivative products are futures, options, swaps, forwards. These are all the types of derivative products: futures, options, swaps, forwards. Structure of Indian derivatives markets. Participants are hedgers, speculators, arbitrators. And infrastructure, NSE, BSE is there, clearing corporations and brokers are there. Trading and settlement in derivatives, margins, daily settlement, physical and cash settlement. So risk control in derivatives, value at risk, via span margin is there, and position limits. Now we'll talk about the use of the derivatives. Hedging against price movements and speculating on trends and arbitrage opportunities. Understanding the market indicators. Track volatility index, VIX, open interest, volume, put all call ratio. These are the market indicators. So the glossary of financial terms will discuss so that you will familiar, that include equity, bond, NAV, net asset value, SIP, systemic investment plan, derivatives, margin, ASBA, clearing corporation, circuit brokers, ETFs, IPOs, and many more we just discussed. No? We have two channels, RR Corporates and RR Legal Talks. Please do subscribe and hit the bell icon so that you will not miss any of our latest updates. Hope you are clear on derivatives, public issues, equity. Thank you. So once you hit the bell icon, so you will not miss any of the latest updates and latest videos on securities markets. Thank you.